Well, there's a collective for the bulls, certainly, because as we break down this week's market action, which ended slightly to the upside, at least for today's session, we have Cathie Wood, ARK Investments founder and CEO, who says it's the bond market, not the stock market, that's in a bubble. Pete Lang, Lang Capital president, will tell us why he thinks every investor needs to be playing defense, and he'll explain how he's doing that. And Phil Strebel down in the pits of the CME. Well, look, the 10-year went back above 2.5%. Suddenly equities picked up a bit. But what about this last hour of the markets where suddenly we went from all red to green? Phil?
Oh, sorry, I didn't hear you there. Yeah, a lot of the commentary was out of Fed President Bullard. We saw him come out and they reiterated some of their inflation targets weren't that far away, that the employment situation was improving, and a lot of the economic data that we've recently seen has been quite encouraging. So I think it was really that commentary that drove it up. Now, we do have some expiration going on with stock options, and I think that the market was really trying to target, that 1875 level, get back up to there. That's where we saw a lot of the puts and calls at. So the option expiration, I think, drove it for a target, and I think that commentary pushed it on up.
Cathie, do you think this move into bonds is going to change now? Do you think we'll see a move out of bonds next week into stocks more?
Yes, I actually think that this week the bond market was driven by fear. People looked at the PPI inflation rate up 0.6%, and yet the bond market rallied, and everyone was short duration, so they all scrambled back in trying to figure out, why is this bond market going? And I just think the bond market's way overdone.
Okay, the bond market's way overdone, but let's just quickly get into that a little bit more deeply. Is Treasury land the place you would be, Cathie?
No, actually, I would be shifting much more into equities. I would have told you that 2 or 3 or 4 years ago as well, which has been correct, but the bond market has done pretty well during that time as well. So right now, though, I'd much prefer equities than bonds.
Pete Lang, you believe in the power of cash, but if you're holding on to cash, you're losing money because of inflation, right?
There's no doubt about it now. We remain invested, but we've got a lot of concerns in the equity markets. For example, when you look at corporate earnings growth over the last 3 to 4 months, we're just not seeing enough of it. What does that do? That's really inflating the risk of the overall market. And when it comes to the individual investors, I really believe that they need to take a risk-off position. A couple ways to do this real quickly, Dave. Number one, you can rotate to bonds, which I think is wise right now.
Wait, which part of the bonds? Because Cathie just said she doesn't like them, so make your case for bonds.
Absolutely. I love high-yield bonds. I don't like interest-sensitive bonds because the 10-year yield is bouncing a little bit. So let's use high-yield bonds. Specifically, let's use bonds that we can use tactical asset allocation at the institutional level. Another theory here is to use equity investors that are also tactical in nature right now. With that, you could reduce your overall portfolio risk of a beta down to 50 or 60 as opposed to maybe an 80 or a 90.
I want to go back to Phil for a second. It seems kind of old hat to talk about gold. Didn't do much of anything today. I think it ended down about $1. But a lot of people are looking at gold and saying maybe now's the time to buy low.
Yeah, anytime it gets below that 1,300 level, investors start nibbling at it. Really, you do have that underlying backdrop theme. You've got the Ukraine. You've got a very weak dollar. I think it's been quite, battered down and beat up. I think it's a cheap investment. You're not getting much yield there on the bonds. You're going to have to really hunt and be tactical if you're looking at them whatsoever. So I think equities, they are susceptible to continue that correction. We've seen about a 2-week sell-off here and there. If we get that nice push down, you can see gold push back through the 1320 level, and it could be a breakout to the upside.
A breakout to the upside. Cathie, let's get to names you like right now. If you're hot on equities, we can put your picks up. Athena Health, Tesla, Illumina. I'd like to talk about Tesla quickly because it has been one of the momentum stocks that's pulled back. When did you start piling in on this?
Well, Tesla we bought on the IPO,
okay,
and held it as it bounced around, and then
remind people how much the IPO was.
I believe it was in the 20s, but I can't even remember right now.
Oh, unbelievable.
Yeah. So all of the three stocks are momentum stocks, and they've been hurt very badly since March 4th, when momentum stocks gave way more towards cyclical stocks as the economy seemed to be picking up. And I do think the economy is picking up. I think revenue growth is going to be very strong, and I'm just getting back to the stock market in general. Revenue growth is going to be strong. Earnings growth, I think, will be much stronger than expected. So we think we'll continue to see the equity market move forward. These stocks, many of them, Athena Health has been cut in half. Tesla hasn't been cut in half, but has had a significant correction. Tesla will be helped, of course, by a good auto market. Athena Health, we think, is the only electronic health record company, actually a health management company, that is completely in the cloud. Jonathan Bush has done an amazing job there and really has no competition.
Pete, you're going for the blue chips. You're staying away from these volatility stocks, Dow Chemical and DuPont. Is that primarily because of the dividends?
Absolutely, Dave. You see me moving to safety here, and that's what investors should be doing. I'd love to see them reduce their risk at least by 50%. Again, I want to be fair with everybody. I'm using these dividend stocks, but I'm only doing so under the guidance of an institutional manager. What does that mean? That means they have strong sell disciplines. If the market starts to proceed down at any given exponential factor, they're going to move to cash. I think that's the most important thing, is having a good defense when it comes to the market.
Well, can you define the amount of the move, the stretch of the move that people should be watching for to then do exactly that and move to cash?
I love that question, Liz. Thank you for that one. Again, to me, I really want to evaluate risk, and I'm looking for risk-adjusted returns as opposed to returns in general. So I want to ensure that my beta in a portfolio is running at about 20, 30 to 40 as opposed to 70, 80s, and 90s. So what's happening right now, a lot of retirees, a lot of investors are coming into advisor's office and pushing 80, 90% of their portfolios into stocks. This is a danger zone, and they should retract. Again, the great ways to do that, rotate. Hey, let's put 20% more of your portfolio into bonds. Let's find a great institutional investor that wants to preserve capital as opposed to get rich quick.
Two different perspectives. We love it. Plus our trader. Thank you so much to Cathie Wood and Pete Lang. Phil, we're going to come back to you in just a few minutes when the S&P futures close.
Thanks, folks. Have a good weekend. Phil, we'll see you.